Let's start this webinar, and on behalf of Clean Cooking Alliance, welcome to our Finance in Action webinar series. We're very happy to see you all here. Good morning, good afternoon, good evening from the time zones that you're joining. My name is Rajiv, and I work as Director of Financing Partnership Platform at the Clean Cooking Alliance. Before we start, a bit of a housekeeping just to better manage time. We have all the participants on mute and have disabled the chat function. Please submit your questions using the Q&A button that you will see. If you tap into the More command, you will see a Q&A button there at the bottom of your screen, and we'll do our best to answer them within the time we have today. You can send your questions as we are discussion is happening and we're going ahead, and we'll be compiling them from the beginning of today's discussion as it goes on. So thank you once again for joining us today. And now let's get started with today's webinar on bank financing for clean cooking carbon projects. Let me bring in Mr. Faisal Hussain, Senior Director, Innovative Finance at Clean Cooking Alliance, to give you a bit of a background to this webinar and introduce you to our panelists. Faisal, over to you.
Thank you very much, Rajiv. Welcome again. Just to kind of recall, I don't know how many of you attended the last meeting, but just to recap, that we have this series of Finance in Action webinar series where we're really looking at innovations and practices that are at the edge of development, which might become sort of mainstream over time. So I'm really glad that we've got an amazing group of people together with us to talk about how we unlock local bank financing, in particular for carbon projects. Catherine, do you want to move to the next slide? Unless I can move it as well. To give you... Yeah, so just to recap, we will spend a little bit of time understanding, introducing the panelists. We'll have an hour of panel discussion with the panelists, which will be moderated by Rajiv. We'll have about 25 minutes of audience questions and answers. You can, of course, put your questions in the chat, and then we can, I will help Rajiv as well, but he will also capture some of those questions and field it with the panelists, and we'll try and wrap up after an hour and a half. So if you go to the next slide, as I said, over the next year, we will be doing this series of webinars. What you see currently is our work streams within within CCA, and it's the Catalytic Finance Accelerator. Our primary mission is to facilitate and catalyze more finance and investment into clean cooking. We have made the very clear strategic decision to have a very strong focus on carbon markets, because some of you who are aware of the industry snapshot and the one which will be coming up in the latest round next year, early next year, the data is really profound, that all investments, or 96% of all investments coming into clean cooking, are coming into those companies that have either carbon projects or are preparing for carbon projects. So which means that if we want to make big progress in clean cooking, we've got to make progress in getting investment and expanding the level of investment into carbon projects. Last time we had the webinar on the Innovation Challenge Facility, which is in your bottom right-hand quadrant. And that was focused around digital innovations. We will today focus on how do we get better market transactions coming through. So that means how do we get the interaction between developers and clean cooking companies and the financiers to come together. And within that, we have the Clean Cooking Carbon Finance Incubator, which some of you will have heard from West Africa last year, and we're in fact, many of us are going to be in Nairobi doing the next cohort for East Africa in Nairobi. Today, our focus is on the financing partnership platform and the work that is being sort of doing together with BICS and Cooperative Bank, Standard Bank. We've had engagements with FMO, but we've not really worked. But and so what we want to do, and of course, there's been lots of engagements with Bern to look at whether there are kind of useful structures that can be put together for to incentivize banks to come in. So if you go to the next slide, the financing partnership platform has really been working on two major areas, which is how do we de-risk investments. That means bringing different partners together, like the African Development Bank, bringing different instruments together, like a price floor guarantee innovation that we've been working on, and helping to structure potential deals that enable banks and companies to kind of work together. So that's sort of one big stream of work, and the second is helping and working with the financial institutions so that they have both the policies, the products, and business processes so that they're able to lend to clean cooking carbon projects initially, but over time, of course, they can expand that out to many others. So for us, so if we go to the next slide, so what we've done, so this has been the stream of work that's been happening for the last 1 year. It's really great that we have an amazing panel of speakers today. And so the speakers are really drawn from individuals who have we've been really working with very, very closely on either transactions or looking at potential transactions for the future, but also independently who've been doing an enormous amount of work that whose sort of insights have actually inspired a lot of the work that Rajiv has been leading on the financing partnership platform. So we're really happy to welcome Lawrence Cole-Morgan. He's the lead in global markets, and we've been working very closely together with Lawrence and his colleagues in Africa to look at how we can do one pilot in terms of financing in Kenya with one organization we can't mention, and similarly Mark Mathenge, who's the sector head at Energy and Natural Resources at the Cooperative Bank. And we've been working very closely with the Cooperative Bank, looking at how they want to develop a full-scale strategy across the organization to think about how they can take a stronger position in financing clean cooking carbon projects. They also have an enviable position of having been certified as a GCF approved developer. So that means we should be able to make progress very, very quickly. We'll welcome Tom Fannin from Bern. Rajiv and Tom have been kind of really working together on potential structures that might work for the financing partnership platform, particularly with the Africa Guarantee Fund. And Tom has been a great supporter and engager with us, particularly on the Banking on Carbon conference that we had. So great to have Tom. And of course, Bern has been at the forefront of really mobilizing incredible amounts of different mix of investments into the company, sort of setting up what might be possible for many other companies. So that's something we want to draw on. And then Ward's with FMO as the senior investment officer. Although we haven't directly worked together very actively, but FMO has obviously taken very strong positions on clean cooking, investing in Systema Bio, investing in many of the banks that provide the financing for renewable energy projects and so on. So we feel that they've been a really big pioneer among the DFIs, and we want to see how we can draw on that experience. And last and not the least, and I deliberately kept Samira Saidi to the last because she's the advisor and the ES lead for BIGS Capital. And I have to say that much of the early sort of pioneering work of BIGS in using carbon contracts as security for financing carbon projects, that's been an inspiration for the financing partnership platform work. So, and of course, we want to kind of draw on a lot of the experience that they've been building into the work moving forward. So the idea is to try and pull a lot of the collective experiences as we move forward. So thank you again. This is a quick introduction. Thank you again for really taking the time and coming. And with that, I want to hand over to Rajiv Gupta. And by the way, I'm sorry that my picture is very different. I thought I'd be Father Christmas now rather than.
Thank you, Faisal. And we get into the panel discussion. But before that, just wanted to share with the participants that, as Faisal was mentioning, that we have been trying to get bank financing into carbon projects. And to be very frank, it has had, there's a lot of opportunities and there's a lot of challenges too. And today's discussion, we wanted to bring out, what have been the kind of positives and initiatives that has been taken. That seems promising, and that's a future that people, the sector would move to. And the kind of stakeholders, both from the investor perspective, the DFI perspective, the carbon project developer perspective, and the banking perspective, can be brought about for the benefit of all. So moving forward, well, the good news from COP29 is Article 6.4, but yes, that good news in action on the ground, how that transforms and when it transforms would be a time-taking thing, I believe. But to start with very encouraging and a positive note, I wanted to, Lawrence, get you first, because you're a bank that has already done a financing to a carbon project or multiple carbon projects, I believe. So. And it would be good to hear from you, how are you approaching these carbon projects? What you are looking into and what your experiences have been for the ones that you have financed. And how are you looking in future in terms of these transactions? So if you can share your experience on how did you go about it and what the experience has been, that would be really nice. Start.
Sure. Because it's actually quite simple about how we approach it, because we approach carbon financing in the same way as we approach any other financing. We're a commercial bank. We're a regulated financial institution, which restricts the risks that we can take. We're not an equity fund, and we're not a mezzanine fund. We are the custodians of our clients' savings, and we have there's strict parameters around what we can and can't do. So when we're looking at when we're looking to fund a carbon project developer, we take exactly the same approach as we would for any other sort of opportunity, and we need to make sure that the cash flows will repay the debt, and that that there's some sort of secondary source of repayment. But I mean, so the challenge really is making sure we can de-risk. But if we can de-risk, the benefit of being a commercial bank is that we can bring sizable balance sheets to bear. But it's and ultimately, when we're looking at financing a new sector, we must sort of try and be innovative about the tools that we use in order to de-risk. And I think it's sort of that unlock in this new sector we're in the same sort of situation in relation to funding carbon projects as we were 15 years ago. Look, when we were financing nascent renewable energy sector. Again, it's trying to apply the principles that we've applied to other sectors and come up with the ways that we can finance in our lane as a commercial bank. Obviously, we do actually put small slithers of equity into certain projects. We will fund and sort of use mezzanine funding instruments, but it can never be as powerful as being able to fund just on a normal commercial banking principles.
Great. And just to dig a bit deeper, and these carbon projects with future, carbon credit revenues coming in, and that being a kind of cash flows that gets affected too. In that terms, with future cash flows as carbon credits coming in, how are you considering those, and are there any secondary securitization aspects that you look into beyond that? So is there any conditionality involved?
Yeah, I mean, ultimately, you know, a carbon project is a project like many of the other projects we look at, and we look at it through a project finance lens. In that, you know, there's an activity, there's a project which needs to be developed, and it'll develop an asset. Time and money will go into developing that asset, which will be sold for in the future. So that future carbon revenue is what will repay the debt, and the challenge we have there is that as we can't take the future price risk on the carbon credit in much the same way as if we're funding mineral extraction. We can't take a future price risk on the price of the minerals. So we have to find a way to de-risk that. And currently, the most obvious way to do that, and the way that we have managed to deal with it, is to fund projects where there is a credit-worthy off-taker that locks in to buy the credits in the future at a fixed price. That gets rid of our price risk. So that opens the door. Now we're able to sort of look at this and say, well, how do we deal with the other risks in the project? And I think the most significant risk in funding carbon projects is the project implementation risk, the delivery risk, that the project will deliver the volume of credits that the off-taker, the minimum number of credits that the off-taker will pay for, that will repay our debt. And that's a challenge, because, you know, there isn't the same sort of experience institutionally, and also in the market generally, on developing these projects, on what can go wrong, and how do you mitigate it. So I think that's probably one of the biggest challenges, is how do you mitigate that delivery risk? And again, let's go back to first principles. How do we do it? I mean, how have we done it in other sectors? In a transaction that we did recently, we applied the same principles we've applied in renewable energy financing, and did a statistical analysis of the delivery risk. In that we ran multiple scenarios on of trying to factor in all the different risk metrics, and came out with a P90 distribution, which, to anyone who's done any project financing will understand, is a distribution which shows you that in 90% of all of the scenarios, that this number of carbon credits will be delivered. But that's a tool we've used in renewable energy. So it's using the tools that we have already and trying to use them innovatively in a new way to try and de-risk some of that delivery risk. That's not always going to be appropriate. So we need to look at other de-risking strategies for that delivery risk as we learn. And I'm hopeful that in a few years' time, as we learn and as we have more confidence and we understand the delivery risks, we'll be able to take more of it. But right now, that's probably one of the significant challenges. First of all, we need to get rid of that forward price risk. And then secondly, we need to find a way to get rid of that delivery risk through partnering with development finance institutions, multilateral development banks, and increasingly insurers.
Great, thanks, Lawrence. And this brings me to Tom. Tom, you just heard Lawrence, right? Who has, as a stand bank, has done transactions on carbon projects, and talking about delivery risk or the forward price risk that's there, but they have actually transacted with clean cooking carbon project developer. And as Bern, one of the largest, in the clean cooking industry, you have partnered with various investors, and recently EIB $15 million went out. That's there towards carbon projects, and you are now exploring to also diversify and have bank financing. What has your experience been in terms of Burn as a company has been able to really get some resources in from the investors. But how are you approaching towards banks, and what's your experience been on that?
Yeah, thanks, Rajiv. Yeah, so just kind of a bit of background on Burn. We've managed to sell over 5 million stoves into the markets across Africa. Largely, we've done that through carbon financing, and to date we've raised over 130 million specifically for carbon financing and projects, which should go towards another 4 million stoves. And that's been a huge success for us to continue to grow and have the impact that we want across Africa and across the world. Those investors are a bit more risk-seeking. They see the opportunity there. To Lawrence's point, the key thing that is a difference is they're taking those investments with the essentially unknown buyer that comes down the line. And when you develop a carbon project, it takes 2 to 3 years to really have any bulk and revenues from the credits that are generated due to the time it takes to monitor those. And that's been something that, as we're going into new investor types and largely talking to banks, that requirement, as Lawrence said, is something that we've been having a bit of a challenge to get off-takers in that scale that we actually want to continue scaling up. A bit of background now, in the carbon markets today, there's been a lot of uncertainty with how these transactions will happen from a government to government. That's kind of more of a regulatory issue that's been happening at the host countries and ultimately the countries that buy the credits as a way to kind of account for the offsets that are happening. That is something that in the last year and a half that's been slower than everyone's really wanted or expected, and that's delayed some of the financing opportunities that we could get if we had committed off-takers. That is largely changing over the next year. We're very, very optimistic that a lot of these things that have been in process are now going to come online. Even this week, there's been some positive announcements coming out of COP that's going on in Baku right now. That are indicating that more and more governments are getting in line and understanding what this is. And once there's clarity there, the buyers are lined up and ready to make purchases. So off-taking agreements will come, and then the financing should hopefully be de-risked, as Lawrence was pointing out.
Wonderful. So you brought in about kind of a change towards the positive side in terms of the government Article 6 kind of transactions being more focused on. And correct me if I'm wrong, but you're saying that is a way to move forward, and that would unlock a lot of financing from different financiers, right? And
sorry,
yeah.
good job.
No, please go ahead.
Yeah, I was just going to say, the key thing there is the buyers have a bit of uncertainty on what they're buying, meaning that the key thing there is they want the corresponding adjustments, which is essentially the mechanism that takes away the offsets of emissions in the country where a project's developed, and able to count that into the countries where the buyers are. And that right. requires some regulation that the host countries have been developing, but it's gone a bit slower. The other thing that's a bit tricky there that they're waiting to see is the price impact from those regulations. And that gets a bit complex because different countries are approaching that in different ways. As an example, Burn's based in Kenya. Kenya put out a framework regulation earlier this year that includes a $4 fee per credit for those corresponding adjustments. Now that that's in place, buyers can at least put into that price into what they're buying and can look at it, is this worth the extra cost of that corresponding adjustment? So even though that is a bit high from our perspective as developers, we can still price that out. And then we have buyers that will be able to purchase those credits as soon as that letter of authorization is given by the government, and we can find buyers with that price point. So as that clarity is coming, the buyers will be ready to purchase, which will give us the offtake agreements. That goes back to Lawrence's point of mitigating the revenue stream on that.
Right. Thanks, Tom, for that. And that brings me to Samira. Samira, I wanted to get you in because Bex Capital has been a first mover in a lot of sense in terms of financing carbon projects as an investor. And certainly there has been a lot of transactions that Bex Capital has done in the past, and you're looking forward to the next round. And some of those has been clean cooking carbon projects that you have financed. And now, as Tom was mentioning, and as Lawrence mentioned about the conditionalities, and Tom mentioned about the kind of things moving forward as a sector, How has BIC's capital experience been in terms of the past portfolio you have or the existing portfolio you have of finance? And how do you see that in respect to the clean cooking sector too?
Great, thank you so much, Rajiv. As a background, I'm Samira Saidi, investment advisor for BIC's Capital. As Rajiv rightfully mentioned, BIC's Capital is a pioneer in clean cooking, primarily in pre-financing clean cooking projects and improved household appliances using a debt instrument. And our financing is primarily pegged on future carbon revenues. So BICS was established years ago, and I think, yeah, from then until now, we have fully invested our first fund and in the process of fundraising for the second fund. And of course, being an impact investor, we were invested into by FMO, IFC, DFC, and a few philanthropic funds as well. So we do have what you call a blended finance facility, which the risk profile enables us to take on more risk and to be catalytic to the sector. So when we started, of course, clean cooking was at the very beginning, where you could see also from the technology itself, it was the very basic improvement from the three-stone fire, an improvement all the same. Whereas now you have a move towards electric cooking and more diversified cooking technologies. When we started as well, we had biogas systems as well, which we looked into, but the technology at that time was also quite basic. So we see a movement in technology, of course, which also improves the quality of carbon credits that are generated through such technologies. We do see also an improvement in the monitoring, whereas now there's digital monitoring and verification. When we started, there was monitoring involved, but quite manual in record keeping, quite manual in the audit process. The methodologies, for instance, in VRM Gold Standard have improved quite a lot to be more rigorous and to have more quality methodologies in place to increase the integrity. And surprisingly, then the carbon price was also quite low. I hear people complaining now the carbon price being low, but then it was also lower. It's only in the middle part of of this clean cooking movement where the carbon prices were higher. I think a few years back, the prices were much higher, and now there's a bit of stability or a bit of a slump in carbon prices. So yeah, the carbon prices have been going, also reflecting on the quality of the credits generated, reflecting on the status of the market where it is. But we do see now a lot of participation from other players. When we started, of course, the perceived risk in clean cooking was too high, whereas commercial banks were not even looking at it. But now we see conversations like this, where, of course, some banks have already invested and more banks looking at investing. So there are quite a number of players, interest as well from the government, whereas before it was only from the private sector. And I think also from a governance perspective, the Article 6 and governments being interested, of course, in clean cooking wasn't there before. But this only brings more demand to the sector, more funding to the sector. And I think as financiers, it's really a time where we really need to put our funds together to grow the sector, because there's a lot of demand pulling in.
So you see a lot of demand pulling in the clean cooking sector, or you're talking about the carbon projects and multiple sectors together in it?
Yeah, I think I would say the carbon sector in general, but also primarily in the clean cooking. I think in the recent years, we've gone through phases in clean cooking. And this, I think, is, of course, with regards to the quality of the credits that are generated. The most recent developments in the clean cooking, we've had lots of news around the quality and integrity of the methodology. But we see this as a phase in development of the sector, that every sector has to go through this. And it will only strengthen the sector going forward.
Right.
Yeah.
Thanks, Samira, for that. And I want to move to what, as an investor, Mixed Capital is looking at a very strong pipeline, it seems, of clean projects and other projects, and they have been investing into it. And as FMO, you have been in this sector for a long time. I'm not talking just about the clean sector, but the renewable energy sector. You have been making both direct investments and also through the banks that you partner with. If you can share, how are you looking at the investments more from a carbon project finance perspective as FMO, and where do you stand, and how do you see collaboration going? That would be great.
Yeah, sure. Thanks a lot. So yeah, by means of introduction, indeed, I work with FMO, the Dutch Development Bank. We have a portfolio of around 11 or 12 billion dollars invested across basically the global south in 3 sectors. One sector being energy, which is where I sit, but we also have teams covering financial institutions and teams covering agri investments. It would be a bit of a lie to say that clean cooking and carbon has been our focus over the last years, but we did invest around $20 million directly or indirectly into the clean cooking space. So in the grand scheme of things, that's not massive for FMO, but it does add up. Next to that, we also have a carbon portfolio in the forestry sector. So it's not just focusing on clean cooking. The bulk of what we've done in clean cooking has been either through BICS as a fund, which Samira already mentioned, or directly to developers. And there our views largely align with what Lawrence has been mentioning, where as a lender, we treat projects pretty similarly across the various sectors. For us, we're not able to take price risk for carbon markets, at least not yet. So for us, the key risk is indeed also around the delivery of the credits, but also around the integrity of the credits. And I think that's where FMO can and will play a role. We do believe that, like Samira mentioned, the integrity of carbon credits has been a bit questioned, right, over the last, let's say, 6 months to a year. But we do think this is a healthy phase for the industry to go through, and to make sure that in a few months, hopefully, we'll have methodologies that are widely seen as being sufficiently conservative, and on the back of which we can see a massive inflow of funds going into the carbon space, and hence also into the clean cooking space. So at the moment, I guess we are a little bit in a wait and see position, where we really hope to have these proper methodologies in place, generally being accepted. Then, like Tom mentioned, the buyers for the credits will come, and then I do expect that we'll be able to provide a lot of financing into this space. We can do so either directly to developers or via intermediaries or by funding banks, like you mentioned. I think there as well, an invitation to any commercial banks that are on this call. Please do, of course, reach out to FMO if you do see a way or a role for FMO to support you in channeling financing to this sector. We are not in the business of providing concessional finance, but we are able to take certain risks that commercial banks may not be able to take, and vice versa, actually. I do think there's a lot of room for collaboration, especially around the topics of carbon markets. I mean, Lawrence, I believe your title is the head of carbon markets for Standard Bank. As FMO, we don't have a head of carbon markets. We don't have any specialists in carbon markets. So I do think there's a lot of joint learning that can also go on to together be able to improve or increase investments into this space. Maybe one other thing I did want to mention is that as FMO, we're also trying to support the market by providing technical assistance or capacity development, more at the broader level than at the company-specific level. So we did do quite some research recently into benefit sharing of carbon credits proceeds with end users of our communities. We engaged a consultant for this and hope to publish the results of it on our website in the coming 1 to 2 months. So basically, that's a study that goes into the level of benefit sharing that we sort of think is fair, and also on the best delivery mechanisms to provide this, whether it's by cash or by other types of mechanisms. And by doing so, we do hope to support a healthy and honest carbon credit market in the clean cooking space going forward.
Thanks, Ford, and we look forward to the report that you mentioned about the instance, and looking forward to the larger involvement of FMO in the space, as you said. And in that regard, Mark, I wanted to come to you. You have heard Lawrence Tom, who is looking at getting more financing, and you have seen FMO moving towards and doing some on the carbon credit side and want to do more. And Samira talked about mixed cap. And you being from the cooperative bank, and of course CC is working with you, as a bank, you have now thought about and planned for getting into and exploring carbon credit finance, right? So why so? And with so much of challenges and wait and watch that's also there. And I do understand the net zeros and the targets and the climate change and green finance side of targets that the banks now get into. But as cooperative bank, I just wanted to understand, as new banks come into the space, what's your strategy? What are you looking forward to, and why you're getting into it?
Thank you, Rajiv. Thank you, Rajiv. Just a bit of background. My name is Mark. I work at Cooperative Bank.
Mark, you need to be a bit louder. Yeah.
How am I clear now?
Yeah, you're clear, but just a bit louder. I think the mic is a bit distant.
Thank you. Rajiv?
Yeah, good.
Yeah. My name is Mark. I work at Cooperative Bank. It's a local bank in Kenya. Just a bit of context is that being a local bank, and like Lawrence said, we are regulated. We are commercially regulated entity, being a bank, and the projects we have to take.
How do I put it? Has to be bankable. Bankable in the sense that every capital that is given out in a project has to be done in a prudential way. So that's it. And coming back to your question, why in all this risk, in all these fear that this why allocate capital to such risky projects? Why do we still want to come into the space? So one of the things that we've noted is that we've seen a number of corporate customers getting into the space, the green funding space, and part of our mandate as bankers, and Lawrence probably will agree with me, is to grow and diversify our portfolio. So any opportunity that you see, you can diversify your portfolio, grow your balance sheet in a sustainable way, is something that we put in. Again, there's the market growth, because again, in the local context, we've seen carbon financing, or having corporates unlock carbon revenues as part of their cash inflows is something that is still in the early stages. Yes, also, of course, Thomas from BAN are way ahead, but we have so many players coming in, and there's a huge opportunity. If you look at the next 3-5 year plan, this would be the right time to get in. Otherwise, by the time you get in, the market will be saturated. So that's one reason. Something else that I'll probably say is that have we funded green projects in the past? Yes. We're talking about on-green projects, solar projects, CNI, or what you call captive projects, but it was purely based on normal commercial terms, collateralized, ready off taker, etc., etc. So in this case, you're looking at a state whereby, apart from just doing the normal funding to green projects, we can unlock, or probably offer that advisory services whereby we can unlock another revenue line called carbon revenue, and then basically uplift our customers as we grow as a business. Lastly, there's something we call corporate sustainability, and of course the net zero targets, like you mentioned. Personally, I believe that if we were to achieve the net zero target that have been set for the country, for different corporates, for us as a bank, it cannot be done single-handedly. The financial institutions as commercial bank has to come in and play in a big part. Otherwise, the net zero target will be, just another, ball kicked down the road. And then that's why as a bank we want to step into this particular point. Rajiv?
Thanks a lot, Mark. So it's quite encouraging to see Cooperative Bank of Kenya getting into the corporate finance space and trying to understand. But just to continue with that discussion, it's great to see the bank getting into it, but the kind of, how should I put it, the kind of requirements as a bank you would have, or where do you see the challenges, or what in terms of capacities or capabilities or business processes, and what kind of support you seem to seek to get you going as a bank on carbon finance?
Thank you, Rajiv. Now, what kind of support do we need? Now, in any carbon project or any project, there's some risks that are involved, and whether or not you allocate your capital to such a project will determine on how well those risks are covered. Now, carbon financing brings a whole set of risks that are quite unique as opposed to normal projects that we finance, which are collateralized. We have a predefined source of cash inflow, or probably an existing cash flow position that that are getting in. Now, in this case, we are looking at things that ideally would be new, in the sense that we have things like biorisk, we have environmental technical risks, in the sense that the project that you might fund, hoping to be repaid in the future from proceeds from the sale of the carbon credits, might not work out. And going back to my earlier comment, yes, I'm a regulated entity. Any capital that I have to give out, it's basically depositors' funds. So I have to be very cautious on how I do it. So if I have to do a trade-off between financing a carbon project or financing a normal commercial project in a real estate trade, etc., where the treasurer sits or where the person who carries the risk sits might be geared towards, or might lie towards the or shine away from the normal carbon project. So how can Mark, as a business development person, yes, I'm a corporate banker, but my main mandate is to grow the business. How do I convince my team or my approvers to, yes, this is a risky project, is a new concept, why do you have to do it? So you're talking about de-risking mechanisms, and I think Lawrence mentioned this earlier, talking about flexible capital. Flexible capital, I'll borrow from what we've done in other sectors, like water still follows within my jurisdiction or my purview, and what we did in the past is that we had a DFI or a funding partner who ideally will not give a grant, but will have a program like AOD, that is aid on delivery, or OBO, output based aid, OBA, sorry, and that capital ideally will help the bank or cushion the bank against any losses. Now, borrowing from past, let's say 2-3 years, we did about 10 projects in the water sector. I think none of them went south. So again, none of them went out. Everything was successful. The fund was a revolving fund, but the good thing again is the fund was cheap. Okay, it was just not only flexible but also cheap. So which enabled us, make huge strides as far as water is concerned. Now you flip the coin and you come to energy, you realize if similar strategies or similar ideas or models were to be adopted by different DFIs. Of course, FMO has just said that they don't do concessional lending, but they can be able to take some particular risks. So those are the partnerships that not just Co-bank, some of the local banks would ideally, need to make this particular progress much faster. I think I've mentioned that about the flexible capital. Of course, the other FX risks, those can be handled internally or externally through various treasury mechanism we have on board. But yeah, if we get a solid de-risking mechanism, looking at the number of risks that are involved, you realize that any business development person, any corporate banker, in cooperative bank or in another bank, because now in this case, you're talking about a country on where we want to go, will be able to convince their approval committee or the approvers that yes, it's risky, but we have a plan B or a cushion in case it happens. And you do 1 ticket, 2 tickets, and then you realize it will just be a normal. It will stop being new. Ideally, right. My colleague Lawrence, who's probably done a number of them, was way ahead. Probably had to struggle to get the first one approved. But the moment you get the first one approved, the second one approved, things starts rolling, and guys accept the concept. Rajiv?
Thanks, Mark. So, yes, to get an approval from the risk team and the credit team and all that kind of processes, that's a challenge. And you did mention about the flexible capital requirement that's there. I'm not sure how much of that is there. If anybody knows of any example of flexible capital deployed into the carbon project finance structures, please do share. But Tom, coming to you, we have been hearing about the risks and price risk and all of that, and integrity and everything else. And as per you have been trying to raise more resources, and it's a continuous job of trying to get more capital. In that scenario, where you are also trying to raise finance from banks, apart from the investors and the conditionalities that are attached with investors in terms of their disbursements, what is the kind of requirements as Burn or as a clean cooking company would you have that can give a comfort to a banking institution? And what could those kind of instruments or products, financial products, you see that as Burn would require from the market that can enable Burn to raise more resources?
Yeah, no, I think we're constantly trying to innovate and create new things that work for everyone. I'll take the kind of direct project financing aspect first. So the two key risks that keep coming up are the pricing risk and ultimately the delivery risk on the projects. We're fortunate enough that we have a very strong team, so that we've never defaulted or had any issues with any of the delivery risks, and we kind of build that through contracting and remedies and everything to give protections there. There is something around the corner, though. I think Rajiv or Lawrence mentioned insurance that's coming up. So there's more and more of these underwriters that are specific to carbon projects. They've started focusing directly on forestry projects at first, but now the products are broadening to have more coverage on cookstove projects as well. And so I think that is going to be a key piece to solve that delivery risk. And I think if you couple that with the kind of banking, the structures that could help unlock the direct project financing. I won't go deep into the pricing risk again, because we kind of covered that before, but the buyers, I also believe are right around the corner. So the next year is something that we should see that have more clarity and de-risking on that side. And to Mark's point, I think this is the right opportunity to start getting understood in the next 2 to 3 years. This is really where this space will kind of scale up and ultimately become saturated. So it's a good timing. However, we have done other structures as a corporate entity. We've also done corporate debt, 45 million. You mentioned EIB before. That's specific for our electric induction cookers, and that's going to help finance receivables financing that will be a portion of that product, because that's pay as you go, and then there's a carbon component of that as well. But we've also done a green bond, and we see that as something that we hope to scale up in a lot of different ways. The nice thing about that is, as we operate across different areas in Africa, you can put that into the market as well, to do specific kind of scaling, especially in markets where we have production facilities that we're building to kind of meet the demands in those regions. That's something I really would love to explore more. I think the difficulty there for where we are today is some of the security that would be required for a carbon specific bond is not there yet. We're hoping in the next few years, because of our size, we'll actually be able to create a structure that works where there's security in existing projects that go into that to actually fundraise for new projects through that kind of bond structure. But we're still kind of not quite there yet. The other way that I think banks can get involved, and I think this is something you've been leading, is with the Africa Guarantee Fund, is as an example. So you have more guarantees that can look at how to cover the portfolios of banks to lend into the space. That would help unlock capital for us as well, because that de-risks from the kind of banking side because of the guarantee that's there. And then there's kind of other hybrid structures that we've been looking at as well, where essentially you have an underlying project that may be a higher risk investor takes essentially an equity portion of that project and a first loss position that a bank can come in on top to lever up. The challenge there we're still having, I believe, is more on the pricing risk side, because we don't have off-takers in place. So again, if that comes, that there's another opportunity to do that, where it's not a direct project finance per se, where you're leading on it, but you could help lever up on the project itself.
Great, thanks, Tom. And you listed a lot of points in terms of green bonds and guarantees and insurance, and even talked about investors coming in for the first loss. And that brings me to Samira. Samira, you as an investor, right? And you have done a lot of transactions, and has there been any experiences of, consortium-based financing that you've done or partnered with other investors on a particular transaction? And I'm asking this question because I want to explore with you is, as BIX Capital, where do you see yourself coming in when there is banks or the banks wanting to finance, and what kind of partnerships can be formed with an investor and a bank for a particular transaction? If you can share something around that, that would be great.
Yeah, thank you, Rajiv. I think for BIX Capital consortium financing, we position it as how can BIX be additional in this role? So as a background, we have a team of carbon experts, primarily expertise in clean cooking and in structured finance. So we have a capability of going deep into the carbon program, understanding the methodologies that have been followed, understanding the track record of a company, or just getting understanding of if they have the capacity to run a carbon program, if they do the monitoring well, what they use in monitoring, which standards they use, the experience in verifying, etc. So we see our role as being additional, such that if we are in a consortium of financiers, we contribute our technical expertise, and that could be additional, for instance, for commercial banks, whereas perhaps they do not have in-house clean cooking expertise. They could partner with a party like BIX, where we have this knowledge and we can go in depth in the due diligence. What we also see is that additionality in terms of the ticket sizes. We are, as BIX Capital, so BIX Capital is fully invested, but when we had the funding, we could partner with a DFI, for instance, and in so doing, increase the ticket sizes that we're able to offer and de-risk the investment, because we have different risk-return profiles. So for instance, if we partner with a commercial bank, you probably would be more risk-averse as compared to us, and this would reflect on the risk-return profile. All this enables the rate to be a little bit blended. And also the return profiles could be that one party is more senior, another one is more junior in the repayment, which gives a relatively comfortable credit product to a project implementer. So there's additionality in terms of knowledge on one hand, and additionality in terms of the instrument itself, where through a structured consortium, either it increases the ticket sizes or also improves on the return profile. I think these two main points are where we see the additionality in partnership.
Wonderful. So one you listed as technical assistance side of thing, and the other thing in terms of joint financing. And I believe that, correct me if I'm wrong, you're also saying that BIX Capital can take a junior position, or just
Sorry, I completely missed that. My audio went on.
No, I was saying as a first loss, BIX Capital can also take care of the first loss as a junior partner to the transaction, right? That's what I was trying to confirm. In your past transactions, you've taken that.
Well, in the first transactions, not entirely.
Okay.
But we are now raising funds for Fund 2, and we wanted to have a different risk return profile. So that's one of the things that we are considering.
Wonderful.
Yeah.
Well, that's good news. And what the same question to you means, as you mentioned, right? So as FMO, of course, the portfolio of carbon finance is growing. It's not substantial as of now, as you mentioned. But seeing forward, means what kind of partnerships you see that FMO can play in terms of with getting into more of bank financing or getting into more of financing towards carbon projects generally, and in specific to clean cooking sector. And how do you see that moving? You're coming out, you're trying to understand the sector, you're coming out with a technical report in terms of that you mentioned about. Where do you see that moving, and what possibilities you see of FMO kind of partnerships with banks coming in the future on the carbon project side of things?
Yes, I think at the moment, indeed, like you mentioned, for us as FMO, it's still pretty early stage. I think we are merely, testing the waters and trying to do another few transactions and then scaling those up. typically what we see is that then at some point we see more commercial bank interest coming in, and then we would usually start taking either junior roles or doing type first loss type structures or shared guarantee type structures to commercial banks to sort of bring them into the space. That's the typical way. We've also seen sometimes sectors like the pay-as-you-go solar sector, for example, where banks like Standard Bank were actually pretty early on in the process, quite keen to take pretty large exposures. And then we like to partner with them early on together to get transactions going, especially when potentially other commercial banks are not yet at the same level of comfort with the space. To some extent, we're also a bit, let's say, demand driven. So again, like I mentioned, if commercial banks do have an interest in this space, but see a specific role for DFIs to partner with or de-risk part of the project, I think we are very open. I think one of the reasons we are on this planet as a DFI is to crowd in commercial funding, because in the end, that's really where the large pot of money is. And I think we try to be as flexible as we can for a DFI to get that going. At some point, we can look at interventions that we've also done in other sectors, where we provide, it's like green lines, but you can tailor that to certain types of projects. We've done so for, let's say, microfinance or SME type financing, where we give banks specific credit lines to use for that purpose. I suppose at some point you could imagine similar things happening for the clean cooking space. But at the moment, it may be a bit soon for that, because of course the volume of loans going into the space is still pretty limited. But over time, as the sector scales up, I do see a role for us there, definitely. Yeah.
Wonderful.
Maybe just
That's
a point of order. So I need to drop, unfortunately, in 1 minute.
Oh, yes.
Another engagement. But if, as I say, if any of the partners on the call or the commercial banks or anybody else feels like discussing things, then either reach out to Rajiv or to me directly if you have my contacts. Happy to explore how FMO can help you.
Thanks, Ward. Thanks a lot for this. And Lawrence, I'm coming back to you. You heard Ward about, the drivers are basically if there is a exposure for the commercial banks on the side, and that also provides a opportunity for the DFI to get into it. But as Standard Bank, who has been now doing transactions on carbon projects, what kind of collaborations you see or you feel is required, apart from the insurance companies and whatever it may be, but in terms of with investors or DFIs and other de-risking agencies, that can kind of enable you to accelerate your financing towards carbon projects. Any thoughts on that and any plans around it?
Yeah, I mean, I think the key elements are people like Ward at FMO, and the insurance market really is actually starting to get quite interesting here. So, but I mean, the development finance institutions and multilateral development banks, I mean, they are sort of key partners and partnerships we're exploring and trying to get there, because they have the mandate. They understand the sort of the key social drivers that are important in relation to clean cooking, and also the environmental drivers that in relation to a lot of the land-based projects. So there are sort of the key partners where we think where we can work with them to help us move faster. Ultimately, we need to get to the point where we understand who the experienced players are here, who the right partners are here from a project development perspective, and we understand how to quantify the risks in the same way as we don't fund with development finance institutions when we're funding renewable energy now. We understand it. We understand the risks. It's a question of those partnerships helping us accelerate up that path, helping us learn. I mean, Samira was made a very good point about the fact that her in-house expertise in relation to assessing clean cooking is something that banks can leverage off, and I'm learning a lot here. That's something that we'll reach out and sort of speak to them about, because we don't have that expertise in-house. We need to build it. So there's not one partnership. There's a number of them. And as Tom mentioned, about the insurance companies are becoming quite interesting now. I mean, we're getting proposals for credit default insurance tailored for carbon credit projects. And that is, again, I mean, ultimately it's always about trying to find a way to get a secondary source of repayment so that I can make this deal bankable, as Mark said. So those are the key partners in this market that we're in right now, where in order to get rid of that price risk, we need an off-taker. I'm hoping that as integrity builds in this market, we will see we'll see the secondary market come back. And if we can get a vibrant and transparent secondary market in carbon credits, not just clean cooking, but if we can get a vibrant secondary market with transparency and liquidity, then we can start seeing other ways to de-risk. Because in the equities market, there are a lot of hedging instruments. We can put on forwards. We can have options, all of which get rid of our price risk and turn that effectively and basically allow us to sort of use the market to hedge our price. We're not there by a long way in carbon right now, but the market's gearing up. As the integrity comes in and there's more people who are willing to buy in the secondary market, that will come. And that's another de-risking tool. So it's not really a partner, it's a mechanism. But I think if we can, if that, as the integrity comes back, as people have confidence to buy in the secondary market, that's another way for us to de-risk.
That's wonderful. And then thanks for highlighting the need for a secondary market there. Of course, the points raised about then the importance of the insurance and the insurance market getting into it. I think that's a great kind of movement that we see in the carbon finance sector. And hope that, clean cooking also benefits from all of that in terms of the partnerships that you mentioned about. I see in terms of time, we are almost there, and I just want to see and stop here and see if there is a Q&A questions there that I can put forth. Okay, I see there's one question. I would, if there are any questions from the participant side, please feel free to note it down in the Q&A window, and we'll just start taking it up. And okay, this is from Japhet Kenyaga. I hope I'm pronouncing your name right. And this is to Lawrence. Lawrence, it's to you. Hi, Cole. How are the banks addressing the future credit price risk? Does it mean that a project developer with no off-taker for credit will have low chances of getting financing? Quite a
yeah. Right now, I mean, I'll go back to the start. Unfortunately, we're restricted in the risks that we can take, and taking that future commodity price risk is a real challenge. And that's why we look for ways to de-risk that. And currently, without an active secondary market, a creditworthy off-taker is pretty much the only route to ensure that we do not wear that price risk. So without an off-taker right now, it's very, very challenging. As I said, if we have a transparent and liquid secondary market and we could hedge that, then that would be different.
On behalf of Japhet and on behalf of the clean cooking industry, I just want to say this is a chicken and egg situation. I'm just putting it to the financier, right? So as a clean cooking enterprise, I don't have an off-taker, and the bank says, or the financier says, the investor says, oh, you don't have an off-taker, I won't finance you. On the other side, I don't have an off-taker because I don't have any finance to start the project or to execute the project.
Yep. So
is there a way that the financiers can look into? And I think that there are some examples where there are conditionalities there, that the disbursements, your project is good, there seems to be under my risk appetite, but the disbursements can happen only when you have an off-taker. What it means is that they're securing the finance, but with a conditionality that, once you have an off-taker, show me that off-taker, a credible off-taker, I agree to it, but then it will disperse you the first tranche. Is there a possibility of those kind of conditionalities coming in?
I think there is. I mean, it's going to be one of the many conditionalities, but I can't see why it would. I mean, provided that we mitigate those other risks, it could be conditional on getting the right off-taker in place. We've looked at structures where we've had, we've actually put in provisions which sort of say, if an off-taker with these characteristics come in, we can lend you more. So it's possible.
That's quite positive and a good news that there is conditionalities that can be put so that we are clear as enterprises, our carbon project developers, that these are the conditionalities that needs to be met. And if it's met, then it's kind of able to secure finance. Thanks, Lawrence, for answering that. And Shima is mentioning daily in sub-Saharan African communities, women are seen carrying their babies while cooking in smoke-filled kitchens. This is mainly because the price of clean cooking technologies are very expensive for them. Currently, I have a project that contributes to solving this problem. Due to my advocacy for clean cooking initiatives on LinkedIn, I got a push to get some improved stoves sent to me. My major challenge to this is finance. How do someone like me access clean cooking funding? Well, Chima, you have been hearing about a lot of financing and the conditionalities that's involved, but I'm not sure. Are you talking about a normal clean cooking enterprise, or you're talking about a carbon project-based business model of clean cooking enterprises here? So please do clarify. And we have been discussing that. But if you can also let me know where you are from, Chima, then I think we can connect you with some of the financiers. Another question is Riffelway Sepothama is writing, I'm currently in South Africa and would like to know if any of the panelists have a presence here and can assist with our initiatives. We are focused on providing clean cooking solutions and addressing energy poverty in marginalized communities through our LPG boxes. Your guidance or any connections would be greatly appreciated. I'll just respond to it. Lawrence, you are based in Joburg. And Riffelway, I hope I'm pronouncing your name right. We have a colleague from Clean Cooking Alliance, Simba, also based in Joburg. So you can connect to both of them and take your discussions forward. Phil Norton is writing, I think cookstove financiers may going forward to be able to take a view on carbon price, but need adequate buffer and strong confidence in the nature of project. Phil Norton is RMB Carbon Finance. I totally agree on it. And that's what's been stressed by Lauren from another panelist here. Anthony Akpaso is writing, for organizations like Tovero Energy, without requisite carbon market experience, looking for scaling e-cooking to countries in Africa, how can we be supported? Anthony, you can just write to CCA colleagues. We can connect you with other partners that you can seek assistance from, and we can take this forward. Shima, okay, you're writing here from Nigeria and the funding that he was looking for grants. Well, that's a different topic altogether, Chima. On the grant side, we are more focused on getting mainstream capital flowing into the clean cooking sector with the kind of carbon projects that's there. But we can take those discussions forward. Any other questions that's there? Okay, so there is one. Yeah, Hunen Khalili is writing, how important is it to a financier to update to the latest methodology of the project as new one keep being introduced, or at least follow the best practices of the new methodology? Who would like to take that up?
Look, I'll take it. I'll give my view first, if that's happy. And Marcus, you are muted as well. So I think it is important. Yeah, it is important because one of the risks that we run as a bank is reputation risk. And I mean, it's not really a financial risk. It's the risk that we're associated with a project, which ends up with allegations of overcrediting. And that's what the new methodologies are designed to do. They're designed to increase the environmental integrity of these projects, to address some of the weaknesses. It would be, and whilst I mean, it's a constantly evolving process. I think we would always be insisting on more recent methodologies to ensure that we could have confidence in environmental integrity.
Wonderful. Tom, Samira, do you want to respond to that in terms of you being a carbon project developer and the methodologies and the challenges you face? Or
Yeah, no, I'm happy to kind of weigh in on that from a developer side. It's going to be crucial, I think, because especially in a space that's quickly improving and some of these integrity issues and getting the best data, making sure that there's conservative estimates out there. Eventually, what will happen is buyers don't want to go with older vintage and older methodologies that have those potential issues on the back end. So without the newest methodologies, without doing best practices, those credits will become something that I would see as stranded assets over time. So it's important to kind of continue and keep abreast of any of the the updates that the methodologies or the standards are putting out there. There's a reason for it, so that's something that will be important for the buyer side as well, which financiers are looking at to make sure that there's a path to recoup the investment.
Thanks, Tom. Samira, as an investor, also you would be,
Yeah, I think I couldn't agree more with what Lawrence and Thomas have already said. There are new methodologies released for a reason, especially now with the claims of overcrediting and the developments in the sector. It only makes sense for a developer to improve their practices and move towards best practices. Whether this is recommended, whether they think that this is by regulation or not, they should do it because it's the right thing to do. So I'm in support completely of what Lawrence and Thomas have said.
great. Thanks a lot. Thank you for this. I feel there's a last question there on the clear methodology for CC as part of that. And Fazilda, I wanted to bring you in. If you can also answer a bit about this. How is the new upcoming clear methodology going to ensure transparency and integrity going to take place? This is from Mohammed Kadi. And then over to you for summary and closing up.
No, thank you, Rajiv. So the clear methodology from a project, there's very specific elements around transparency, information, integrity, just having confidence in what is actually being reported against. So the clear methodology is probably the most latest up to date. There's obviously the new one that Vera came up with and Gold Standard came up with as well. Currently, the clear methodology is working through the system with Gold Standard. They should be approving it by the end of this year. And it is sort of the gold standard, and I don't know whether Tom has a view, but we've been working very closely with project developers, buyers, and then other registries as well. But besides that, you may already know that we've been working on something called the Responsible Carbon Finance for Clean Cooking Initiative and developing codes of conduct for project developers. So that will provide greater confidence around transparency and integrity, not just at the level of the project, which is what clear methodology tries to do, but it will try to do it at the level of the project developer so that you combine both at the developer side with what's happening at the project level as well. And that but I think the key point right now is that you've got really great improvements in methodologies. There's probably better than it's ever been. And I think this is something Shamira talked about, Lawrence has talked about, everyone's talked about. We've probably got it as well as we possibly can make it, particularly now with also other digital technologies and so on, that gives greater confidence on what's being generated and how you can monitor it. And two is that we now have a range of other governance arrangements from ICVCM to VCMI to the Responsible Carbon Finance Codes of Conduct, that when you collectively take all of these things, provide enough confidence, particularly for buyers and financiers, to say that, okay, we are reasonably good because of all of the different elements that are coming together. It is not the wild west of the CDM days, let's put it that way. So I think with that, I don't think we have any more. Do we have any more questions? No. No. So I just wanted to say this has been a really interesting conversation and very difficult, I suppose, to try and synthesize. But I think there's probably 5 points I kind of heard came through clearly from, I'm trying to pick on sort of the common bits. One is that clean cooking is very similar to many other emerging markets that we've seen before, whether it's water, whether it's renewable energy. And all of these go through periods of development and difficulty and with perception and reality of risk. But just as those sectors have evolved, the clean cooking market is beginning to evolve now with methodologies, with insurance companies, all of the different elements that are needed in order for the de-risking to take place so that we can get a volume of projects coming through so that traditional financiers can see that this can be relied on and they can make investments in. And so I think what I heard was that that clean cooking is at I wouldn't say early stage, but it's at a mid stage of development. It's still waiting for a critical mass of projects to come through so that it's significant in size for the financial sector to respond. It remains a sector that is, just like any of the other sectors, dependent at this current stage with blended finance, because they're supposed to essentially de-risk. But as more and more blended finance comes in, such as the FMOs and so on, we will get to a stage when blended finance draws out and more commercial finance comes in. The kind of work that Lawrence and Thomas, certainly Tom, talked about as well. And I think BICS is a sort of a mixed hybrid. It is a blended finance structure as well. And over time, we should see sort of BICS transition into a completely commercial, hopefully, operation once the sector sort of takes over. So I think one message is that the sector is getting more mature. There is more confidence because of methodologies, all of the different risk instruments that are needed to address concerns of finances are coming together. I think the second thing that we heard was that currently the sector, because it's very dispersed, the capacity, both in terms of instruments, but also capacity, is dispersed as well. So the sector isn't big enough to have everything in-house yet, right? So until we get to a point where there's critical mass in the sector, it's really important that different parties are actually coming together in partnership. So as Lawrence was saying, how does he draw the capacity from Samira? And similarly, how for example, Samira can draw, say for example, the Africa Guarantee Fund guarantees to underwrite some of the risks there as well. And then finally, how does Mark with Cooperative Bank come in and blend the finance between a commercial bank and an international kind of fund and a DFI such as FMO. So I think the key thing, the message that I'm sort of hearing is that there remains significant risk, and the risk are delivery, but we've got solutions coming along through the insurance sector, and solutions in terms of capacity building of lots of organizations so that it's not just going to very large organizations, you're actually growing the market as well. Second was around price, and that again has a long established sort of contracts or off-takes that can try and solve some of that problem or is solving, but of course not everybody can get it. But I think Tom was saying with Article 6 coming along and sort of better standards there, then we should see demand increasing and therefore many more off-take contracts coming together. It still doesn't solve necessarily the volatility in prices, but it certainly deals with the demand part. And I think over time, what we will see is some development of a secondary market where you could have a derivative type of instruments like CFDs that will then help to take care of the volatility in prices on carbon credits. So I think very interesting dispersed experience. The more we're able to kind of come together, and I think that the very fact that we have this group is the kind of group that we need to kind of all kind of do a journey together to get transactions through, and we'll probably get some significant critical mass coming together. So I'm absolutely sure we haven't dealt with everything, and I don't want to even try, but thank you again very much indeed for taking the time, the investment to come in and share your experiences. And thank you very much indeed for all the people who've attended this meeting. We will share out the report and a summary of the conversations as a report for everybody who's attended and those beyond as well. And of course, as Rajiv has said, you're welcome to share your contacts, and if you wanted to connect with others, we will help facilitate the connections to all of the members here, but also beyond as needed. So thank you very much. And thank you, Rajiv, for